Hey, freedom fighters. Rob Berger here, author of Retire Before Mom and Dad. Back with you with another video. This one is launching what will be a series of videos that I'm going to put together to help you become a better investor. I'm calling it the How to Invest with Confidence series. And it's really going to give you everything you need to not only understand the terminology and the strategies of investing, but to be able to do so with some confidence. You know, we're in the middle of a bear market now as a result of COVID-19. And boy, I'll tell you, having confidence in your investment strategy has never been more important. And it really kind of gave me the idea of putting together this series. And so that's what we're going to do. Now, in this video, you can think of it as Investing 101. What I want to do is put together and walk through a framework. That's probably too fancy a word, but a framework of the things that we need to think about when it comes to investing. And I think we can boil down just about everything we need to think about as investors, for the most part, into 5 questions. And that's what I want to go over with you today. And then as we go through this series in future videos, we'll be diving down into each one of these questions and parts of these questions to cover everything from how to create an investment plan, to the difference between actively managed mutual funds and index funds, to how to keep your investment fees low and why it matters. And if you're listening and you don't know what some of those terms mean, don't worry about it. As we come upon each one, I'll explain it in detail. Today, just want to focus on these 5 questions. It will put into context everything we're going to be looking at going forward. All right, so let's get started. Even put together a PowerPoint presentation for you. 5 questions every investor must answer. And the first question is simply, when should I start investing? And obviously a question that those at the beginning of their financial journey are asking. I see it come up in a number of different contexts. For example, people will ask me, should I pay off all my debt before investing? And I know this is a strategy that's been popularized by Dave Ramsey. He thinks you should pay off all your non-mortgage debt before you start investing. This is one area where I disagree with Dave. I think for a lot of people, this could hold you back. This could keep you from investing for years, in some cases, maybe even a decade or longer. And I think for most people, probably not the best approach, but it's still a question that many folks have to answer. Again, in future videos, we'll be diving into that in more detail. Kind of a related question I see is, should I save up a 6-month emergency fund before investing? Or another one, should I save up to buy a home before investing? We have multiple financial goals in our lives, and sometimes it's tricky to figure out which one should take priority. Should I focus only on one goal? Should I juggle multiple goals? It's not always an easy answer, and we'll be covering a lot of that in future videos. But it's a question that each of us, when we're starting out, has to answer one way or another. Now, another kind of question I get, and this is not only from those that are beginning their investing journey, but those that have already invested for a while, is the current market a good time to start investing? I have a lot of folks there, when the market is up, we're in a bull market, and it seems like every single day the market gains more and more and more. People are afraid to invest because they're afraid that at any moment the floor could fall out from underneath us and we could go into a bear market. And then when we're in a bear market, it's sort of the opposite concern. Well, goodness, I don't want to invest now. Things are uncertain and there's a lot of volatility, and it seems like every day the market's down a lot. Who would want to invest then? Now, those that know me and have followed the podcast and my blog know I think we should be investing all the time. I think trying to time the market is a big mistake, but I understand the concerns and I understand these sorts of questions, and they're important. And I've covered them to some extent in previous videos, but we'll be looking at these issues going forward in future videos. But again, they all relate to the one question: when should I start investing? Or if you're already an investor, should I stop investing for a time, right? It's the same kind of question. That's question 1. Question 2 is, how much should I invest? And this comes at us in a couple of different ways. One is, how much do I need to invest, if I want to meet a specific goal? And in most cases, that's retirement. In some cases, it's a child's education. We'll look at this in some detail. There are some both free and paid tools online that you can use to help you answer that question. But it's a tricky question, particularly if you're years, maybe even decades away from either you're a child going to college or from retirement. There's a lot of things that can happen between now and then, and knowing exactly how much you can save is not always an easy question, and it's certainly not an exact science. But we do have ways to at least try to understand that question and answer it. Another thing that I see is some folks will say, look, I want to save as much as I possibly can, even more than I might need for retirement at a traditional age. Maybe you want to retire early or whatever your goals might be. And the question becomes, how do I manage my monthly budget so that I can free up as much money as possible to invest? That's sort of another but similar question, but from a different perspective. And then another one is, and this is related to question one in a way, it's how much do I invest when I have other financial goals that are important to me, other financial priorities? It's usually not just one thing. And you might want to contribute to a 401k and save up an emergency fund and save for a home and save for a child's education. How do you juggle all of those priorities? Again, not an exact science. I really strongly feel there's no one right answer for everybody. I know there are some financial gurus that will argue that there's one and only one answer, and it applies for everybody. And I think that's just silly. But I do think there's a lot of factors that we can think about and consider as we make those decisions for our own situation, our own families. And again, we'll be covering that in a future video. So the first two questions, when should I start investing and how much should I invest, kind of relate really to general personal finance topics as they implicate our investing decisions. The final three questions we're going to look at now are more specific to investing itself, all right? So question 3, what type of account should I invest in? This is really, once you've decided that you're going to start investing and you have an idea of how much you're going to invest, you're ready to go, this is actually the first question that should be asked, and I think it gets skipped a lot. I've watched a lot of videos on YouTube, I've read a lot of content online, and people want to immediately throw you to a robo-advisor or Vanguard or invest in this hot stock or this mutual fund. And they've skipped over an important question. What type of account should we be investing in? And here's what I mean. And I know there's a lot here. I actually want to start with taxable accounts first. Probably should have switched the sides, but let's start with a taxable account. You can think about that as a savings account, a CD, or a brokerage account, a mutual fund account at say a Vanguard or Fidelity. These are just your standard taxable accounts. And what that simply means is any income you earn from that account each year, whether it's interest from a savings account or interest from a bond mutual fund, or perhaps dividends from a stock mutual fund, they're taxable. They're taxable in the year that you earned them. Now, that's one type of account. The other general type of account are what I call tax advantaged accounts. And there's a couple of different ways to look at these. There are employer accounts and individual accounts. And by employer accounts, I just mean 401ks, which you're probably familiar with at work, perhaps. A 403b, by the way, the difference there, 403b is effectively the same thing. It's just that 403bs apply to folks that work at like charities, for example. And you might say, well, wait a minute. Why do charities have 403bs, but if I work at a for-profit company, it's a 401k? Well, the answer is it's just different provisions of the Internal Revenue Code apply to for-profit companies versus nonprofits. And all the 401k or 403b is the particular number and reference in the Internal Revenue Code. That's where they get those numbers from. Same thing with a 457. The TSP, if you're a government worker, in the military, work at the post office, that's just what they call your 401k effectively through a savings plan. But those are all employer accounts, which means you can't go out on your own. I couldn't go out on my own and just open up a TSP or a 401k. It would need to be through an employer. I mentioned HSAs, health savings accounts, and those are accounts that apply if you have a high deductible insurance healthcare plan, and many of those are through employers as well. I mentioned pensions and profit sharing, although If you have those, you normally don't control the investments, but some of you might be lucky enough to have pensions or profit sharing. But all of those types of accounts are through your employer where you work. And then you have individual accounts, meaning these are accounts you can go and open on your own. And probably the primary one is an IRA. You may be familiar with that. I mention HSAs here too because you can actually open an HSA on your own. You can't contribute to it unless you have a high deductible health plan, but you can open your own. You don't have to contribute through an employer. And so this could be an individual account as well. So when we're thinking about tax advantaged accounts, and I know I'm throwing a lot at you, don't worry, in future videos, we're going to go through what you need to know in detail about all of these. This is, again, just to kind of give you a lay of the land. But you can think of them, again, between employer accounts and then accounts you can go out and open on your own. But the other way to think about these accounts is Roth versus traditional. And again, if you're not familiar with those terms, the difference has to do with how they're taxed. A traditional 401k, or sometimes you might be referred to as a tax-deferred 401k, when you make your contributions in a given year, you don't pay taxes on that amount of money. But when you retire and start to take the money out of the 401k, you do get taxed. With a Roth 401k, it's just the opposite. You are taxed on money that goes into your 401k, but then it grows tax-free, and when you retire 10, 20, 30, 40 years later, say in your 60s or 70s, and you take your money out of a Roth, you don't pay any taxes. You don't pay taxes on the amount you contributed. You don't pay taxes on any of the growth in that fund either. Now, as you might imagine, there are pros and cons to both, something, again, we'll cover in future videos. But it's important to understand the real takeaway here is the type of account you should invest in is a very important question. And really, you have to answer that before you decide where you're going to open your account. And that gets us to the fourth question. Where should I open an account? Let me go back to question 3 for a moment. With an employer account, you don't decide where to open it. Your employer does. They have a 401k administrator or a 403b administrator. At Forbes, where I'm a deputy editor now, our 401k is with Fidelity, right? I can't call up Forbes and say, hey, I want to have my 401k account at Vanguard. Can you mind moving it over from Fidelity to Vanguard? The answer would be no, Rob. That's not how it works. With an employer account, they decide where the account is going to reside. And it turns out, by the way, just for me, that all of my 401ks over my careers both as a lawyer and now as an editor at Forbes have all been just worked out this way. Have all been with Fidelity. But of course, your 401k or other workplace retirement account could be with someone else. With an individual account like an IRA, you decide where to open it. And that gets us back to question 4. Where should I open an account? It's an important question. Again, doesn't apply to employer accounts, but for an IRA, for example, or a taxable account, you could open it up at a mutual fund company like Vanguard or Fidelity, could use an online broker, could use a robo-advisor. Again, don't worry if these terms are new to you, but for robo-advisors, think Wealthfront. Betterment is another example. You could use fintech. You may be familiar with like Acorns, for example, or Stash. These are iPhone and Android apps. They're often called, some of them are roundup apps, where they'll round up your purchases, take that money out of your account, put it in an investment account for you, and invest that money. It's kind of an easy way to invest small amounts of money over time. But the point is, once you decide what type of account you'll want to invest in, the next question we need to think about is where you're going to open that account, again, if it's not an employer-based account. But these decisions are important. They can affect you long-term, and so it's something to think about and something that we'll cover in detail in future videos. Okay, finally, question 5. What in the heck do I invest in? This is where we get to things like asset allocation, stocks versus bonds. How much should I put in a stock mutual fund versus a bond mutual fund? Should I invest only in U.S. stock mutual funds, or should I put some in an international stock fund? Here we go, large cap versus small cap. And what does that even mean? Real simple, large cap is just companies that are large in terms of their valuation, think Amazon or Apple. And small caps would be companies that have much smaller valuations, many of which we've probably never heard of. Um, should we invest in REITs, which is just a real estate type of investment, or commodity funds? There you can think of oil and gold and that sort of thing. These are all important questions, I think easy to work through, and we'll be doing that in future videos. Should I use a target date retirement fund? That can be an easily one fund solution, but there are certainly downsides to target date retirement funds. I'm going to do an entire video just on target date retirement funds. What about the three fund portfolio? That's a simple way to, I think, create an excellent asset allocation using just three mutual funds. One would be a US stock mutual fund, one would be an international mutual fund, and the third one would be a bond fund. But we're going to cover that in future videos and walk through why that kind of portfolio would work, and even give you specific funds you could use to construct a three fund portfolio, whether you're at Vanguard or Fidelity or Schwab or somewhere else. Should you invest in actively managed mutual funds or passive mutual funds, also known as index funds? And some of you may be saying, well, what in the world does that even mean? We're going to cover that. Again, these concepts are not difficult, but the terminology can be confusing over time. And so we'll cover all of that and what the terms mean. Now, some of this may have raised more questions than it answered, and I guess I apologize for that. But I really wanted to go through these 5 questions because they set up the framework for the videos that I'm going to release over the coming days and weeks. Everything we talk about boils down to one of these 5 questions. When do I start investing? How much should I invest? Once I'm ready to invest, what type of account do I invest in? And if I have to open it myself, where should I open it? What are the advantages and disadvantages of all the different options? And once I've got the type of account and I know where I'm going to open it, or it's going to be an employer-based 401k, great. How do I pick the mutual funds or other investments that I'm going to entrust my hard-earned money to for what will be decades? So those are the 5 questions. That's the framework. And starting in just a couple of days, I'm going to be releasing the first video, and we're going to walk through all of these questions over the coming days, weeks, and months. So if you haven't subscribed to the channel and you'd like to know when these videos come out, please do so. And if you found this video helpful, please give it a thumbs up. Again, it's a very introductory video, again, designed to set out the framework that we're going to follow going forward. But I think it's so important, particularly for new investors or those who are questioning their investment strategies, to have this framework, and we'll begin to develop it and expand on it in the coming days. Until next time, remember, the best thing money can buy is financial freedom.